What if the most dangerous financial trap in the world isn't losing all your money in a sudden market crash, but watching your most productive decades slip away? While convinced you were doing everything right, it sounds impossible. Until you look closely at the balance sheet of an everyday high earner turning 40 years old. Right now, millions of hardworking professionals are walking straight into a silent, invisible financial wall. They earned the degrees. They climbed the corporate ladder. They increased their salaries year after year, and yet, when they stand at the edge of 40, they discover a terrifying truth: their wealth engine is completely broken. But why does this happen to smart people? And more importantly, what is the hidden financial mechanism that allows a rare few to break free, while everyone else remains trapped on a golden treadmill? To understand this anomaly, we have to examine a real-world case study. The story of a senior project director named Marcus. On paper, Marcus looked like the picture of modern success. By his 39th birthday, he was earning a baseline income that put him in the top tier of earners. Driving a luxury sedan, living in a prime suburban neighborhood, and contributing modestly to a standard retirement plan. If you evaluated Marcus from the outside, you would assume his financial future was locked in stone. But when an elite corporate auditor took a look inside his actual financial structure, what they discovered was shocking. Marcus wasn't building wealth at all. He was running a high-revenue, zero-profit business every single month. Cash flowed into his accounts, and every single month, that exact same cash was consumed by high fixed costs, lifestyle adjustments, and hidden overhead. Marcus had spent 15 years increasing his top-line revenue without ever building an underlying asset engine. He was trapped in what institutional analysts call the high-velocity illusion, where the perception of heavy cash flow masks a complete lack of permanent equity. And here is where the story takes an unsettling turn, because right down the hallway from Marcus worked a senior analyst named Sarah. Sarah earned 40% less than Marcus, drove an ordinary sedan, and rarely talked about money. Yet, by age 40, Sarah had quietly built a self-sustaining financial network, an independent system that generated enough continuous cash flow to match her entire annual living expenses. How could someone earning significantly less money end up holding tenfold the real assets? The answer isn't locked in secret stock picks or lucky gambles. It lies in a powerful business strategy that corporations have used for decades. A strategy that 90% of individuals completely overlook until it is far too late. You see, Marcus viewed his income as money to be allocated across expenses and lifestyle upgrades. Whatever remained at the end of the month was saved, but Sarah viewed her personal finances through the lens of a venture capital firm. She treated every single dollar not as currency for consumption, but as an employee deployed to acquire cash-flowing infrastructure. When Sarah received a raise, she didn't upgrade her apartment or lease a newer vehicle. She executed what top-tier business strategists call an immediate capital sweep before her paycheck ever hit her standard checking account. A predetermined percentage was automatically routed into a separate investment vehicle, purchasing productive assets that worked for her 24 hours a day, 7 days a week, while Marcus was busy servicing liability costs. Sarah was acquiring underlying asset velocity, but just as Sarah's strategy was beginning to exponentially compound, a massive market shift occurred, testing both of their systems in ways neither of them saw coming and exposing a second, far more dangerous mistake that almost every 40-year-old investor makes when trying to catch up. When the shift hit, Marcus panicked, realizing he had lost 15 prime years of exponential growth. He tried to fast-track his path to wealth. He began taking massive, unhedged risks, chasing speculative trends, high-yield promises, and volatile trading systems. He believed that because he was late to the game, he had to take dangerous gambles to make up for lost time. This is the exact moment where the trap snaps shut for late-stage investors. When human beings feel the sting of lost time, their brains shift from rational decision-making to emotional desperation. They abandon steady, proven systems and begin seeking dynamic shortcuts. But in the world of capital markets, seeking shortcuts when you are behind is the single fastest way to set your timeline back to absolute zero. Marcus lost over 40% of his liquid reserves in less than 12 months trying to hit a home run. Meanwhile, Sarah did something counterintuitive. Something that looked completely boring on the surface, but mathematically guarantees long-term dominance. Instead of taking higher risks, Sarah implemented the principle of asymmetrical asset scaling. She concentrated her remaining resources into simple, low-friction, high-clarity asset classes while using market volatility to her advantage when asset prices dipped. Her automated system purchased more underlying value for the exact same price, effectively lowering her cost basis and accelerating her compounding curve without taking on existential danger. To truly understand how Sarah turned modest capital into absolute financial freedom, we have to reveal the 3 hidden structural strategies that fast-growing businesses use to scale. Strategies that you can apply directly to your personal life today, regardless of your starting point. The first hidden strategy is known as capital containment. Most people assume that building wealth requires massive, dramatic sacrifices that ruin your quality of life. But high-growth enterprises don't cut their core operations to grow. They simply freeze their operational friction while expanding their revenue. When you freeze your baseline living standard for just 24 months, while directing 100% of new raises, bonuses, and side earnings straight into asset creation, you break the lifestyle inflation cycle forever. You create a massive positive spread between what you earn and what you burn, forcing your capital into compounding channels automatically. The second strategy is the institutional reinvestment loop. When an average individual receives a dividend, yield, or profit from an investment, their instinct is to spend it as a reward, but top-tier capital operators treat early yields as sacred resource multipliers. Every dollar generated by your assets must be immediately fed back into acquiring more assets, creating an unbroken, self-reinforcing wheel. In the early stages, this loop feels painfully slow, almost invisible. But once that wheel completes its 3rd or 4th cycle, the math flips, and the income generated by your portfolio begins to outpace the income generated by your daily labor, and that brings us to the third and most critical strategy of all, the removal of emotional friction through systematic automation. Human psychology is hardwired to buy when things feel safe and sell when things feel terrifying. But the greatest asset accumulation opportunities in human history always happen when the world feels unpredictable. By taking human emotion out of the loop and setting up automatic capital routing, you turn market uncertainty into a mechanism for rapid equity building. You no longer have to guess. You no longer have to worry about timing the market.